Welcome to VeriScope News. This channel focuses on verified information and clear context. Each report explains current data using official sources and established reporting. The goal is understanding, not reaction. Today's briefing examines new data on U.S. weekly unemployment claims. The information comes from reporting by Reuters and U.S. labor statistics agencies. This report explains what the numbers show, how they fit into longer trends, and why they matter for the broader economy. All figures are stated clearly. All context is presented without speculation. Weekly unemployment claims are one of the most closely watched labor market indicators in the United States. They measure how many people file for unemployment benefits for the first time. Because the data is released every week, it provides a timely view of labor market conditions. Small changes can signal shifts in hiring, layoffs, or economic momentum. Over the past several years, the labor market has moved through multiple phases. There was a sharp contraction during the pandemic period. That was followed by a rapid recovery. More recently, conditions have shifted into a slower and more stable phase. In this phase, hiring has continued but at a reduced pace. Layoffs have remained limited. Job openings have declined from earlier peaks. Wage growth has moderated. Weekly claims data helps track whether this balance is holding. It also helps identify early signs of stress. However, the data can be volatile. Seasonal factors, holidays, and administrative timing can all affect weekly numbers. Because of this, economists focus on trends rather than single-week movements. They also compare weekly claims with payroll growth, unemployment rates, and participation data. The latest report fits into this broader context. It does not stand alone. It reflects how the labor market is behaving at the start of the year. According to the U.S. Department of Labor, initial claims for state unemployment benefits increased slightly last week. Claims rose by 1,000 to a seasonally adjusted level of 200,000. The data covers the week ended January 17th. Economists surveyed by Reuters had expected a higher number. The consensus forecast was 210,000 claims. The actual figure came in below that estimate. This indicates that layoffs remain limited. It suggests that employers are generally holding on to workers. The report also noted recent volatility in the data. Adjusting for seasonal patterns around the end of the year can be challenging. Holiday schedules and temporary layoffs can distort short-term readings. Despite this noise, economists described the labor market as stable. They use the term low hiring, low firing to characterize current conditions. This means companies are not hiring aggressively. It also means they are not cutting jobs at a rapid pace. The claims data also aligns with recent payroll information. The survey period overlaps with the time when employers were assessed for the January employment report. In December, non-farm payrolls increased by 50,000 jobs. That figure was broadly in line with the monthly average for 2025. In addition to initial claims, the report included data on continuing claims. Continuing claims measure how many people are receiving benefits after their first week. These claims fell by 26,000 to 1.849 million for the week ended January 10th. This decline reflects several factors. Some individuals returned to work. Others exhausted their eligibility for benefits. In most states, unemployment benefits last up to 26 weeks. The report also referenced upcoming revisions to payroll data. The Bureau of Labor Statistics plans to publish updated benchmark estimates. These revisions are expected to show slower job growth momentum over the past year. To understand this report, it helps to look at longer-term trends. Over the past decade, weekly unemployment claims have averaged higher than current levels. Before the pandemic, claims often ranged between 220,000 and 250,000. During economic downturns, claims can rise sharply. During stable expansions, they tend to remain lower. The current level, near 200,000, is historically low. It suggests limited layoffs across most sectors. However, payroll growth has slowed. In 2024 and 2025, job creation moderated compared with earlier years. The Bureau of Labor Statistics has estimated that about 911,000 fewer jobs were created in the 12 months through March 2025 than previously reported. This overcounting was linked to the birth-death model. That model estimates job gains and losses from business openings and closures. It relies on historical patterns. Starting with the January report, the BLS will adjust the model. The changes will incorporate more current sample information each month. This aims to improve accuracy as economic conditions evolve. Economists also point to structural factors affecting hiring. Businesses face uncertainty around trade rules and immigration policies. They are also investing heavily in automation and artificial intelligence. These investments can raise productivity. They can also reduce immediate demand for new workers. At the same time, labor supply growth has slowed. Demographic changes play a role. Participation rates among some age groups remain below pre-pandemic levels. Taken together, these factors contribute to slower but steadier labor market dynamics. Households. For households, stable unemployment claims provide some reassurance. Fewer layoffs mean income disruption is less common. However, slower hiring can make job changes more difficult. Workers who lose jobs may face longer search periods. Prices. Labor market conditions influence inflation indirectly. Slower hiring can reduce wage pressures. More moderate wage growth can help stabilize prices over time. Jobs and labor. The low hiring, low firing environment means job turnover is limited. Opportunities exist, but competition remains strong. Workers tend to stay in existing roles longer. Savings and investment. Stable employment supports steady household savings. However, slower wage growth can limit increases in disposable income. This can affect long-term financial planning. Businesses. For businesses, holding staffing levels steady reduces costs. It also reflects caution about future demand. Investment decisions increasingly focus on technology and efficiency rather than headcount expansion. Economists are monitoring several indicators. They include monthly non-farm payrolls. They include the unemployment rate. They include labor force participation data. Upcoming benchmark revisions from the Bureau of Labor Statistics are also important. These revisions will provide a clearer picture of job growth trends. Weekly claims will continue to be watched for sustained changes rather than single-week moves. For viewers, the data suggests stability rather than acceleration. The labor market is not showing signs of rapid deterioration. It is also not showing signs of renewed expansion. Understanding this balance helps place headlines in context. Weekly movements matter less than consistent trends over time. Seasonal adjustment is a key technical factor in claims data. It attempts to remove predictable calendar effects. These include holidays and school schedules. When patterns shift, adjustments can introduce short-term volatility. This is why economists rely on moving averages and longer-term comparisons. That concludes today's VeriScope News analysis. The report focused on verified labor market data and long-term context. Future updates will continue to track these indicators as new information becomes available. Thank you for watching VeriScope News.